Federal Reserve just lowered rates for the first time in over a year after keeping them historically high, and they did so by a historically large cut at 0.5%. But why are interest rates across all other forms of debt actually moving higher after the Fed's cut? Well, it's because of a combination of a couple factors we're going to talk about. Number one, the Federal Reserve controls some interest rates and only influences others. Number two, government spending and borrowing also has an influence on many interest rates. And number three, the reason why this matters for you is because interest rates affect you, number one, in how much it costs you to borrow money, but number two, how much it costs you to buy things that other people use debt to purchase. Now, if you don't know who I am, my name is Joe Brown. I'm a former stockbroker who spent years advising the top 1% on how to manage their wealth. And after making enough money to leave that world behind, I've now turned my attention to teaching people financial strategies that exist outside the mainstream, things that you'd never hear from your typical broker or advisor. So first, let's take a look at this chart. This is the federal funds rate, and this is the interest rate that the Federal Reserve actually outright controls. And when people talk about the Fed cutting rates or raising rates, this is actually what they are referring to. Basically, this is the amount, the interest rate that banks get paid for holding overnight reserves. You can see from the beginning of this chart until about 1980, the Federal Reserve was raising the Fed funds rate, and after that, they were on average lowering the Fed funds rate. This led many to speculate during 2021 and 2022 that the Federal Reserve would not be able to actually raise rates much because for the last 40 years, every time they raise rates a little bit, they have to drop them suddenly afterwards. But they blew through that trend, and for the last year have been holding rates steady at between 5.25% and 5.5% until this very recent surprise drop of 0.5%. And if we zoom in on just the last couple of years, here's what that little drop looks like. Now, many people have been waiting years for the Federal Reserve to finally declare victory against inflation and start lowering interest rates in order to make debt payments more affordable again. So many people were very excited when the Federal Reserve finally announced that yes, they were moving forward with rate cuts, and the first one was starting off with a bang at 0.5%. But this interest rate cut had the opposite effect on pretty much all other forms of debt. We're about a month removed now from that meeting where the Federal Reserve cut interest rates, and yet interest rates across other forms of debt have actually started to rise. If you take a look at mortgage rates, you can see that they bottomed at the end of September and since then have been moving higher. And while 15-year mortgages are lower than 30-year mortgage rates, they still are following the same trend of moving higher since bottoming in September. Now, this one in particular has made many people fairly upset because your mortgage payment is the largest expense for most people. Many people who purchased homes within the last couple of years have been waiting patiently for the Federal Reserve to lower rates so that they could refinance at a rate that was more affordable for their budget. However, rate cuts have not had the expected effect on mortgage rates. But it's not just mortgages. If we take a look at credit card interest rate, they just notched a new all-time high at over 21% on average. Now, if you carry a credit card balance, that is one of the surest ways to prevent yourself from ever getting wealthy. It is very easy. It is a slippery slope to get into credit card debt so steep that you cannot get out. But even if you don't go that far, carrying a balance simply means that every single purchase you make with that credit card becomes more expensive. And now it's not just 14% more expensive, it's 15 or 18 or 20 or 25% more expensive. And remember, this over 21% average for credit card interest rates is the average. I've seen numbers over 35%. There are no investments that have that rate of return consistently, yet you are that investment for the bank. If you can use a credit card without carrying a balance, fine. But if you can't, treat it like an addiction, cut it up, stay away. But it's not just credit card debt either. If we take a look at the interest rate on new car loans, that just notched another high at 8.76% for 72-month loans versus the prior high in November of 2023 at 8.67%. 60-month auto loans as well just notched a new all-time high at 8.4%. If you've been following me for some time, you know this is exactly what I've been predicting for a while. That Federal Reserve will cut interest rates, but it will not result in lower prices or lower interest rates for the rest of us. Credit card debt is more expensive now. Mortgages are more expensive now. Auto loans are more expensive now, and it doesn't even stop there. Since bottoming in September, interest rates on 10-year government treasuries have risen back above 4%. Yields have risen on the 20-year as well, and on the 30-year. The only government debt that has not gotten significantly more expensive over that time is short-term government debt underneath 1 year. So what exactly is going on here, and why is debt getting more expensive almost across the board, despite the fact that the Federal Reserve has now started cutting interest rates? Before I answer that, I want to tell you about something very important I have coming up. It's no secret that we are heading for one of the most contentious elections in US history. Two candidates couldn't be more different, and the polling odds are changing by the day. That's why on November 3rd at 7 p.m. Eastern time, just 2 days before the election, I'm hosting a live Zoom call to detail something I call the election chaos trade. It's a very specific trade that has historically soared in the months following an election. In fact, in the past, this trade has thrown off gains as high as 173%, 363%, and even as high as 1,455% in a matter of months following an election. And even though massive 1,000% gains are generally the exception and not the rule, I want to show you why I think this year's election chaos trade has the potential to be one of the biggest yet. If you're interested, simply click on the link in the description below, register for the event, and then show up on Sunday, November 3rd at exactly 7 p.m. Eastern time. Attendance is completely free, but seats on the Zoom call are limited. Look forward to seeing you there. So why are interest rates rising despite the fact that the Fed has started cutting? Well, you see all these interest rates that we looked at, the 30-year, the 20-year, the 10-year, auto loans, credit card rates, and mortgages. None of these are outright controlled by the Federal Reserve. Some of them the Federal Reserve has influence over, like Treasury rates and mortgages, because the Federal Reserve buys some of these loans from the open market. When you buy up debt, all else being equal, that's going to drive down the rates because bond yields and prices are inversely tied. So when you buy up debt, it drives the price up, which drives the yield down, and vice versa. If the Federal Reserve decides to sell a bunch of debt, it'll drive the price down and the rates up. But again, that's all else being equal. They are not the only player buying and selling that debt. For instance, with US Treasury debt, you also have the federal government, and every time they borrow more money, that's the same thing as them selling more debt onto the market. That's going to drive prices down, yields up. But even the federal government is not the only big player. You also have large financial institutions that are buying and selling this government debt on a day-to-day basis. And so with interest rates on long-term government debt headed higher, that tells us something that the free market is anticipating. And what they're anticipating is future inflation. You see, the September CPI report came out hot, higher than expected. This is evidence of what many of us have known for a while, that interest rates that are too low set by the Fed allow the government to spend more and borrow more than they should. Because all dollars are loaned into existence, this increases the money supply, which drives up prices. And while the federal government may have a hard time borrowing at the long end of the curve with 10, 20, and 30-year treasuries, they're having no problem right now borrowing at the short end of the curve with things like T-bills. So as the Federal Reserve lowers rates, they're basically only making it easier for the US government to borrow short-term debt. This allows them to spend more, borrow more, driving newly created money into the economy, driving prices higher. Now, if you're going to loan money for a long period of time, let's say with a mortgage for 15 or 30 years, or a credit card debt that just keeps on getting rolled over, or an auto loan for 5 or 6 years, or to the government for 10 or 20 or 30 years. You're going to want some sort of assurance that not only are you going to get your dollars back, but you're also going to get your purchasing power back. Because if your total pile of dollars increases by 5%, from $100 to $105, but everything that used to cost you $100 goes up in price to $106, yeah, you got your money back, but you didn't get your purchasing power back, which means the Federal Reserve is in a catch-22. As they lower interest rates, mainly at the short end by lowering the federal funds rate, which is the overnight rate, they are increasing the inflationary pressure on the economy, especially for the long term, which drives long-term interest rates up higher because it enables more government spending and deficits. And this is not just some theory that some guy on YouTube has concocted. concocted. This has happened before. In the 40s, the debt to GDP ratio was over 120%, just like it is now. Over the following 40 years, the government deleveraged as they printed more money and the Fed held interest rates low, so the government could deleverage relative to the size of the economy. During this time, inflation rose, and the Federal Reserve had to continue to raise interest rates. And even things like the 10-year bond yield continued to soar higher, which meant interest rates and prices went higher for everybody. But the key thing here was that the Federal Reserve made sure the government could deleverage through things like yield curve control and other tools the Fed has up their sleeve. It's the exact same playbook now. We are in a long-term cycle of a government deleveraging through inflation. Higher rates and higher prices for us, more borrowing and more printing for the government. And in a world of easy and infinite money, you definitely want to hold more and more scarce and hard assets. As always, thank you so much for watching. Have a great day.